Hello, financial enthusiasts! Welcome back to Stock Market Catalyst, where we reveal the secrets to financial success and building a solid foundation for a brighter future. Today, we're diving into a topic that can open up a whole new realm of opportunities for investors: options trading. Whether you're new to investing or a seasoned pro, understanding options is critical for expanding your knowledge and potentially increasing your results. In this video, we'll take you through the basics of investing options, covering key concepts, strategies, and potential benefits. So, if you're ready to take your investment journey to the next level, let's get started. Before we dive into the details, let's begin by answering a fundamental question. What are options? Simply put, options are financial derivatives that give investors the right, but not the obligation, to buy or sell an asset, such as stocks, at a predetermined price within a specific time period. This flexibility can provide unique opportunities to generate profits and manage risk in various market conditions. Options trading provides investors with an alternative method to invest in the performance of a security like a stock or an exchange-traded fund or ETF. Through options trading, investors aim to take advantage of the upward or downward movement of the security while investing only a portion of the total cost required to own the actual security. Let's take this as an example. Imagine there's a stock currently being traded at $100. If you were to buy a share and the price increased by $5, you would experience a 5% return. However, through suitable option contracts, you can achieve a profit from the same price jump in the stock while only paying a modest premium that costs significantly less than owning the stock outright. The advantage of options trading lies in the ability to potentially earn more with less investment. Nevertheless, it's important to note that along with the potential for greater profits, there is also a higher risk of experiencing losses. To provide a clearer understanding of the topic, let's delve deeper into the mechanics of an option contract. Unlike buying a stock directly, when you purchase an option contract, you're not acquiring the security itself. Instead, you're acquiring a contract that grants you the right to buy or sell a security at a specific price before a predetermined date. Consider this example. Assume there is a coffee shop chain called Stone Curb Coffee whose stock is now trading at $50 per share. An investor believes that Stone Curb's stock price will rise. Given the predicted price movement, the investor considers purchasing 100 shares of the stock. However, the investor has concerns about the initial capital required for this investment. Now, let's consider another investor who already owns 100 shares of Stone Curb stock and intends to hold onto it for a while. This investor believes that the stock price will not experience significant growth over the next few months. Both investors can utilize a call option in this scenario. A call option is a type of option contract that grants the buyer the right to purchase shares of Stone Curb stock at a predetermined price, known as the strike price, within a specified time frame called the expiration. In this case, the strike price is set at $55 per share and the expiration is in 4 weeks. Typically, a standard option contract represents 100 shares, so purchasing this contract would give the buyer the right to buy 100 shares of Stone Curb stock at $55 per share. The buyer acquires the call option contract by paying the option's premium. The premium, or the cost of the option, is determined by various factors, including the current stock price, the time remaining until expiration, and the implied volatility, which reflects the expected movement of the stock during the contract's lifespan. The premium paid by the buyer is credited to the seller of the call options and helps partially offset the original purchase price of the stock. Let's imagine that the total premium for the call option is $100. Our buyer pays this amount to purchase the contract. Now, let's explore the potential outcomes of this investment. Suppose the buyer's instincts were correct and the stock price of the Stone Curb is currently $60 per share. Remember, the call option grants the buyer the right to buy shares of the stock for $55 each. In this scenario, the buyer could exercise the call option, purchasing 100 shares for $55 each, and then sell them at the market price of $60 each. This would result in a profit of $5 per share, not accounting for any commissions. Since the stock of Stone Curb has risen by $5, the buyer's call option contract is now worth $500. If the buyer were to sell the contract, they could potentially make around $400 in profit, which is the value of the contract minus the $100 premium they initially paid, as well as any commissions or fees. However, the seller of the call option didn't fare as well. Although they collected $100 for selling the option, they missed out on a portion of the stock's appreciation because they were obligated to sell their stock at the predetermined price of $55 per share. Now, let's rewind. Let's consider a situation where the stock price moves in the opposite direction, and it is currently being sold for $45 per share on the last trading day before the expiration. In this case, the buyer's call option contract grants her the right to purchase shares of Stone Curb for $55 per share. Since no one would be willing to pay $55 for a stock that is available for $45 in the open market, the buyer's contract is likely to expire without value. As a result, the buyer is now facing a potential loss of 100% of her initial $100 investment, in addition to any trading commissions and fees incurred. On the other hand, for the seller of the option, the fact that the option expires worthless is good news. The seller still retains ownership of their shares of stock and earned $100 by selling the option. Although the value of their shares has declined, they were able to keep the option premium received and are not responsible for any commissions or fees associated with selling the option. It is important to note that the example provided earlier is a simplified representation. The pricing of options is considerably complex, highlighting the necessity of educating oneself about options and their associated risks before investing. While the primary factor affecting options prices is the price of the underlying asset represented by the contract, there are other influences such as time decay and implied volatility that impact options prices. We have demonstrated one example, but options can be utilized in various ways. Call options, as we have seen, can yield profits if the price of a stock increases. Conversely, put options can be profitable if the price of a stock decreases. Furthermore, calls and puts can be combined in different manners. Through buying and selling these options, investors can have the potential to profit from market movements in any direction and create strategies with varying levels of risk. And that concludes our exploration of the basics of options trading. If you found this video helpful, please consider giving it a thumbs up and sharing it with others who might also benefit from the information. I love hearing your thoughts and ideas, so feel free to leave a comment below. Thanks for watching, and we hope this video has provided you with valuable insights into the basics of options trading. Happy investing, and see you in the next video.